Well, good morning, everyone. Hi, Ron.
Hi,
It's been,
Kath.
it's been a while.
It has, and you're recovering, and I really appreciate your being a trooper and doing the show, and I hope you just have a lot of fun with this. There's no stress. It's good
Yes, we're,
stuff.
we're just going to have a wonderful time. So today is the Baby Boomer Investing Show, and this is season 2, episode 18. And today we're going to talk about congressional requests for review of target date fund risk and practices. So, what exactly does that mean, Ron?
Well, that's what we're going to do the whole show about, and I've got 50 slides, so I'm going to have to go really fast.
Okay.
So why don't we just jump right into it and do the next slide, Kath?
Okay.
Next one, yeah. Oh, how did that happen?
I don't know. Whoa. I don't know.
Oh no, I don't want to do a commercial.
Yeah. There
There
we
it
go.
is.
There we go.
Thanks.
I must have pushed the wrong thing, folks.
All right. So our fourth show, our very fourth show, is about target date funds. So here we are again. They're very important. They're at about $2.5 trillion. They became popular because the Pension Protection Act of 2006 made them a qualified default investment alternative, which basically says for people in a 401k plan who can't make a decision, this is the place where most of them go. They go into target date funds. And the top chart is basically saying what a target date fund does is on the far left, for people who are 40 years away from retiring, young people, is pretty aggressive, mostly in equities. And as the target date gets closer, it gets more and more conservative and moves more to bonds. So Congress reviewed target date funds in 2009 after the debacle in 2008. But on the next slide, Kath, these two senior Congress people, Senator Patty Murray, who's the chair of the Health, Education, Labor, and Pensions Help Committee. She's the chair of that. And Bobby Scott, who's chair of the Committee on Education and Welfare, Representative Bobby Scott. The two of them wrote a letter to the Government Accountability Office, to the controller. And his name is Mr. I won't get his name right, but anyway, the letter is a request for a review of target date fund risk. And it gets very detailed and says we're worried that this thing that's become a big deal now could lose a lot of money. So we'd like this report, and they asked 10 questions. It's on the next slide, but I'm going faster because I have to.
Okay.
So nobody's going to have time to read these 10 questions, but let me say I'm going to go through them one at a time. And people who are watching this, you're going to say, well, you're not the Government Accountability Office. The nerve. They're supposed to be answering these questions. 9 of the 10 questions are about information. And it's not about opinions. It's not about anything else. So I'm going to show you the answers. They're commonly available. If you want to answer them yourself, you could do it. So I'm going to answer the first 9. The 10th one does ask for an opinion. It asks for a recommendation. And that's the big deal. I'm going to spend a lot of time on what I think Congress should do and why they should do it. So on the next slide, Kath, in response to their letter, I wrote an open letter, and that's available on the internet, so anybody who wants to read it. But bottom line, what I say in the letter is I'm so happy that you all have reached out and realized that target date funds do need a serious look. In my opinion, they're way too risky, and we said that in the fourth show last year. But this is, I think this could be a big deal. But I'll say this: I look every day for someone who wants to write about their request, and it's just the press isn't. There's a little bit of press picking up on it, but it's died down. So this their letter came out May 6th. A little bit of activity in the press, but it's been very quiet lately. So I hope the world doesn't forget about it. Now, before I get into answering the questions, I want to set the stage on the next slide, Kath. So I want to talk a little bit about the Thrift Savings Plan, which in their letter to the Government Accountability Office, GAO, they bring up the Thrift Savings Plan, and I want to talk about that. And the fact that the questions that they're asking really um, need to realize that there are basically two distinct factions in target date funds. And I'm going to talk about those, and they're really different. They're very different. And then this, we talked about this in my book. It really is very different this time. Normally, when somebody says that, it's not true. This time, it's true. And in particular, bonds are very, very risky, and people are writing about that now. And so I'm going to talk about those things, and then I'll go into the questions. So on the next slide, in their letter, they say that they've looked at one of the target date funds that's big, $16 billion. But there's even bigger ones, much bigger ones that have the same thing. They're 60% invested in stocks at the target date. And that's not half of it, because the most of the remaining 40% is in risky bonds. So in 2008, when the target date funds had their biggest losses, bonds were fairly safe. They're not anymore. So these funds are almost 100% in risky assets. On the other hand, this thrift savings plan, which is it's $770 billion. It's the largest defined contribution plan in the world, and it's federal. So the Senate certainly and Congress should certainly keep in mind that this federal fund is totally different from what most target date funds are doing. And it's 60% allocated to very safe assets, so it's very safe. On the next slide, I want to tell you a little bit more about the thrift savings plan. And I'm going to make them my poster child for what target date funds should be. So they're huge, $769 billion, 6 million participants. By the way, this is the plan that soldiers get enrolled in. So it's for the military. It's for people who work for the government. So it's a huge deal. And on the next slide, now this is really, I think, a key point for addressing the questions and the recommendations. There really has become two very distinct groups of target date funds. One is very much like the thrift savings plan, which again is very big. But we've been talking about the SMART Target Date Fund Index that I manage. And then there's a union, the Office Professionals International Union, that is also very much like the thrift savings plan that I work with. So the thrift savings plan isn't the only target date fund that has an emphasis on safety. There are others. The rest of the industry is really very much like what's called the big three. And we've talked about this too. In that episode, there's an oligopoly. This is a $2.5 trillion industry. 3 companies manage 65% of that $2.5 trillion. Vanguard, Fidelity, and T. Rowe Price. And there's a history there. The reason they manage so much is they're the largest what's called bundled service providers, which means that they do the accounting and the reporting and all that other stuff. So when target date funds became popular starting in 2006, they were the naturals, plan sponsors, fiduciaries, just out of convenience and familiarity, would use these 3 firms. So they've become huge. And I'm just going to touch on this a little bit, but since I'm on this slide, the fiduciaries, especially advisors, have come to believe that if they don't use something like these big 3, that they are violating what's called procedural prudence. Procedural prudence says act like other fiduciaries, and all the other fiduciaries are using these 3. So it's become a fiduciary risk to not use these big 3. And that's got to change. There's just the risk is just so huge there. So on the next slide, just to set the stage again, and we've talked about this several times, but in the introduction to my book, we talk about how things are really different. And the interest rates have never been lower. Stock prices, people argue that maybe they've been higher before, and this is sort of hard to normalize your measure of what's expensive in stock prices, but I believe, and others as well, believe that stock prices have never been higher. The U.S. has never printed more money. We've printed $9 trillion for sure so far, in quantitative easing, and in COVID relief. $9 trillion, by the way, is more than the cost for us. So I'll put it out back up. World War II was our most expensive war, and in today's dollars, that cost us $4.5 trillion. So we've printed twice what we printed for World War II, and by the way, that's stating in today's dollars. And there's probably another $6 trillion on the way with environmental and so on. So we're spending crazy.
Yeah, we're in deep doo-doo.
And you know, the world's starting to see a little bit of inflation, and we're being told, "Oh, it's temporary; it's going to go away." I hope, but I don't see that even how they can be possible. And then the wealth divide we see every day on TV. So the rich have really gotten richer. Quantitative easing just line their pockets, and the poor are getting poorer. And by the way, the poor in this country aren't really poor by the global standards, but when we see all the rich people, we get mad. So on the next slide, this will be the last one to set the stage. This is the history of 10-year interest rates going back, I think, 100 years. Over on the far right is where we are today. And so you can just see, your eye tells you it's never been lower. But the key thing is on the right-hand graph, and it's a measure of interest rate risk. It's called duration. And in 2008, when we had the last market correction, bond duration was down around 4. So it helped. So your allocation to bonds in 2008 reduced the amount of impact on your portfolio from a stock market that went down 50%. Today, that risk on the duration is 70% riskier than it was in 2008. Bonds are risky. And people are writing about that. So we're in an environment now where the usual asset that would be used to defend, especially in target date funds, if interest rates go up, which I think they will, bonds are not going to be able to defend. So now, drum roll, we're ready to go on to the introductory slide, Kath. I'm going to provide answers to the questions. And again, I'm not trying to step on the GAO's toes because these are just for information. So, and I think I document as we go through here, but the information is accurate, believe me. So the first question on the next slide, Congress wants to know how widely used target date funds are. And there's a study here in Investopedia, and basically half of the participants in 401k plans have defaulted. And they've defaulted mostly in the target date funds. Then there are some participants that have not defaulted. They're making their own decisions. And that increases the participation to about 75% of the people in 401k plans are in target date funds. Now, the next 25% aren't all in target date funds. They generally use some target date funds and some not. And these self-directed people seem to be confused in the Congress's questions as if they are the main participants. They're not. The defaulted people are the main participants. So I'm going to clarify that when we go through the answers to these questions.
Yeah, that just even you saying it, it becomes a little. I'm glad you're going to clear it up. It's
fuzzy, and they ask about, for example, they ask about how participants choose target date funds. Defaulted participants don't choose them; they're chosen for them.
It's chosen for them, right?
Yeah. So that's really a key thing here, and I'm sure when the GAO answers this, they'll make that clarification. I'm going to do that as we go through here. The next one doesn't matter. The major question that Congress wants to know is basically they say how is risk mitigated? How are target date funds defending? And they specifically ask what happened in 2008 to target date funds, and our last sort of correction was the first quarter of last year when we had the reaction to the pandemic. So the market went down quite a bit. For the last year event, the big three group was down 20%. And that most of that happened in just 1 month, the month from February 20th to March 20th. So just imagine a 20% loss in your assets in just 30 days. And it was catastrophic. The group that defends, the Thrift Savings Plan Group, TSP, was down 4%. So that group defended. The other, we only had 2 tests, and I think that's really why there's a lot of comfort in target date funds, and basically a belief that they're safe, but they're not. Certainly not at the target date. So in 2008, the typical target date fund was down 30%, while the defensive group was down only 5%. So we only had 2 tests. The big 3 group failed both tests, and they'll certainly fail the next one for reasons that are shown on the next slide. I skipped question 3 just in terms of the order. I went right to question 4. And question 4 really deals with the structure of target date funds. And what I'm showing here are what is called glide paths. And the way this works is the vertical scale is the equity allocation. And that's generally used as a measure of risk, but there's more to risk now because bonds are risky. But just be aware that right now I'm just showing the equity allocation. And then the horizontal scale is the number of years to retirement. So on the far left, you'd be 50 years away from retirement, and then on the far right, you're starting retirement. The 3 curves at the top are the big 3: Fidelity, Vanguard, and T. Rowe Price. They all end at the target date with 55% in equities, all 3 of them. I mean, they differ a little bit through time, but when you're about to retire, they're 55% in equities. Then most of the balance, basically 35%, is in risky bonds. So bottom line, these big 3 like target date funds are 90% in risky assets. It's a lot of risk. Then the other paths down here are the TSP, and then the SMART and OPIU glide paths are pretty much the same. So those 3 service providers end at the target date with less than 30% in risky assets. And the balance, the 70%, is in very safe assets. So it's not in bonds. It's in basically treasury bills and intermediate term tips. Now, the solid orange line here is really interesting because PIMCO and MassMutual have done surveys, and they've asked, the PIMCO study asked consultants, the MassMutual study asked investors how much risk they want to take. And you can see that for younger people, they want to take a fair amount of risk. And that's pretty much in line with just about everybody. So there's a lot of agreement for young people about how much risk to take, at least as measured by equity exposure. But those surveys all basically agree that as you get 5 to 10 years away from retirement, you should be very, very safe. So the world's telling us that it wants to be safe. Consultants in particular it's a crazy situation here because they say they want to protect the beneficiaries that they're consulting to, but they choose target date funds that are very risky. So there's a disconnect there. So now I'll go back to question 3, which is more about information. And this one's an interesting one. Bottom line, it asks the question, basically, do these target date funds who try to market time, do they work? The answer is basically no. They lost pretty much the same amount of money in 2008. They're actually pretty new, so not many of them were around in 2008. But certainly in the first quarter of last year, they did not deliver on this. What they basically say is, we're going to defend just before the bad things happen, and it's been proven over and over again that's really, really, really hard to do. So the next question is question number 5. And that one is basically, how are TDFs marketed and represented? They are, in fact, presented as one size fits all, set and forget it. And the marketing part of that is it's a one decision choice. You just do it. It's on cruise control. It's so easy. Everybody's using it. Why wouldn't you? And then in terms of the objectives, which are really, we're going to come up with that, but the objectives that are normally stated for target date funds is that they are designed to replace pay. So when you retire, you sort of be able to get some reasonable percentage of your past pay. and what's called managed longevity risk, which they say they're going to try to make your assets last a lifetime. Those objectives argue for the risk that's in here because people aren't saving much. I'm going to talk about this, but I really believe, and I think the TSP group believes, that the really objective should be to deliver at the target date all the money you've saved through time, don't lose it, plus a reasonable return, and really defend against losses, especially near the target date. So totally different set of objectives. So one size fits all is a problem. On the next slide, there's a related question from Congress. And the question basically is, some percentage of target date funds are being provided on what's called a custom basis, which means if a consultant comes in and sort of designs something special for you, for the company, and designs a glide path and uses the funds on the platform, and that's called custom. And Kell & Associates has reported that 17% of the target date funds are custom. They're being built basically by consultants. 87% are non-custom. Now those don't add up, so I guess there's some overlap between the two. But there's a newer thing on the horizon that I think Congress should know about and certainly be aware of. And this is an idea called personalized. So custom is still one size fits all. It's sort of trying to design a single target date fund that hopefully will sort of be in the middle of the workforce and sort of service that particular group of people. But it's still one size fits all. This idea of personalization is starting to catch on in a couple ways. One way is some target date fund providers are saying when you get 5 to 10 years near your retirement date, we're going to take you out of your target date fund and we're going to give you an advisor, and it's what's called a managed account. So for that last 5 to 10 years, you get hand holding, and hopefully somebody will do a good job for you. Another way to do that is with a family of target date funds, and basically an advice service that helps you decide what mix of target date funds you might want to use. And that family, by the way, is really a good thing for people who are not defaulted. So non-defaulted participants really should be provided not just with one target date fund, but with a family of target date funds. And a lot of these questions really sort of deal with choosing between a target date fund and other assets. This expansion to a personalized view would give the non-defaulted participants a chance to move between different levels of risk for a target date fund. So I hope I haven't lost the audience at this stage. It does get complicated, but it's a very important consideration. Then the next question is really interesting. But I'm going to simplify it here a little bit, but it's just, do the people who buy target date funds, and the word again is the participants, do they do their research? Well, first of all, again, most participants aren't doing research because they're defaulted. But second, fiduciaries could do research, and they're certainly recommended that they read the prospectuses and understand the funds that they're looking at. But at the end of the day, and that's why these boxes are over these people's heads, fiduciaries are just choosing the big three. They might go off those big three a little bit, but the acid test for even going away from the big three is, are they reasonably close to the big three? Because I'm not going to take the procedural risk of not using them. So the answer to this question is no, there's really not much research being done. Fiduciaries primarily rely on their consultants. Consultants primarily rely on procedural prudence. And so here we are with this high-risk situation. Next question is about the Department of Labor. Question number 8. The Department of Labor came out with their tips in 2013. And they were okay, but they're just suggestions. They're not anything, with teeth. But one of those suggestions was really mind-opening. So they suggest that you choose your target date fund on the basics of the demographics of your workforce. And if you take a step back from that and you say, so the only demographic that you should really be concerned about is the demographic for the people who default, because that's the assets that are going to go in there, mostly defaulted people. There's only one demographic that all those people have in common, and it's that they're financially illiterate. If they weren't financially illiterate, they would not default. They would make their own decisions. And that brings us to the realization that the duty of care, which is a fiduciary duty, is like our duty to protect our children. So fiduciaries are responsible for any avoidable harm that might fall to these very vulnerable, naive people. So that really, really argues for safety. Then the other thing that I would fault the Department of Labor for, in their tips, they never even mention this very well documented time in everyone's life called the risk zone, when if you lose money, it could change the rest of your life depending on how much you lose. And it's related to a concept called sequence of return. And this is very well known by retirement researchers. They've documented, you Google these words and you'll find a whole bunch of stuff to read. But we have a chart on the next page, Kath, that gets into it. MFS Research created this example that a lot of people are using, but in this graph on the right, there are two paths here. One starts out with 3 losing years right out of the bat, and then the remaining years are up. The path on the top reverses that. The good years happen first, and then the 3 losing years happen at the end. And what you can see there is, if you're one of the unfortunate ones, and this is a matter of if you're unlucky and you lose money early on in retirement, it could be life altering. You could easily run out of money, very quickly, and that's what this red line is showing you. Whereas if you're lucky and you make a reasonable amount of money early on, later on in life you really don't care, because you've built up this reserve and you're all okay. So this is a risk that's sort of like what you might call airplane risk. The odds might not be so high that you're going to suffer, but the consequences are severe. So stuff I've written lately, and others as well, as baby boomers right now, 78 million baby boomers, are going to spend most of this risk zone in this decade. And this decade follows an incredibly great 12-year time period. But now it's plagued with all these, it's different this time. Those 4 things are all signaling red. So I don't think baby boomers are going to make it through this decade without taking a significant loss. And this sequence of return risk is going to click in. So Congress is concerned about the risk is good. I just hope that whatever reaction is happens soon enough to protect our 78 million baby boomers. Question number 9 is on the next slide. And this one really is directed, I think, to non-defaulted participants, because it asks about how people decide between a target date fund and other assets. And what some plans are doing, this is sort of a recommendation, even though Congress isn't asking for a recommendation of this thing. It would make sense to offer multiple target date glide paths. One would have to be the default, and I personally think that should be the safest one. But then you could have other glide paths that would be more aggressive. And then the non-defaulted participants could choose. They can mix and match. Their situations might change through time. If they win the lottery, they don't need to take risk anymore. They just play safe, or vice versa. If they've got new kids and stuff and they need to make more money, they might want to move to a more aggressive plan. So that's the answer to 9. Now 10 is the drum roll.
Da, 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 da.
Yeah, da-da-da-da. The question here basically is to the Government Accountability Office: what would you recommend be done to mitigate risk in target date funds, to make sure that they're reasonably safe? And they also ask about a recommendation that would help achieve the objectives of target date funds. And that second part of the question is key because the objectives have been created to sell product. So if you say my objective is to replace pay and manage longevity risk, you've already told someone who hasn't saved enough that you're going to try to make up for their lack of savings with investment returns. If you say the objective is to be very safe and protect your assets and not lose your money, that leads to a totally different glide paths. So what happened in June of 2009 is the first and only ever joint meeting of the SEC and DOL took place to specifically address the losses that occurred in target date funds in 2008. Again, they lost around 30%. The entire focus of that whole day meeting was just on the 2010 funds. So those were funds for people who were near retirement or retired in 2008, the 2010 fund. And the outcome of that was they asked for opinions on incorporating the ending equity allocation in the fund name. And the pushback was so severe that didn't happen. And in fact, nothing happened. So the whole day meeting, SEC DOL on top of it, we're going to arrange to make this thing never happen. Nothing happened. Then 4 years later, in February of 2013, the Department of Labor came out with its tips, recommendations for selecting target date funds. Never even mentioned sequence of return risk, never even mentioned the risk zone. So that's shocking. Basically, bottom line is the only sort of recommendation in that whole thing that made sense to me is the demographic thing, and the only demographic that matters is lack of financial sophistication. So with that as background, I'm really hopeful that this recent effort won't fall by the wayside and that something will actually happen. And my recommendation is this. Congress should require the disclosure of the risk at the target date. They should require that in the fund name. So someone would say it's the 2050 fund with a moderate risk of losing money, or the 2050 fund with a severe risk of losing money. And the one that I like is the 2050 fund with a negligible risk of losing money. Now, that failed in 2009 because there was legitimate pushback that said equity allocation there's more to risk than equity allocation. And that's definitely true today because bonds are risky. So what's the better measure? I have some ideas, but I'm not going to push that onto my recommendation here. But my recommendation is that Congress should appoint a committee, hopefully of some really smart people, people with credentials and leadership and respected and everything else. And they should create this measure. And it can be low, middle, high. It could be something more, variable than that. But at a minimum, low, middle, high. And they should develop rules. And they might even go out and actually assign individually to individuals. There's only about 40 target date fund families. So it wouldn't take much to actually do the assignment to all 40. And then the providers should be required to report that risk at the target date. Now, I think that's a simple recommendation. And what it does is it learns from the failure that happened in 2009, where nothing happened. So on the next slide, Kath, I want to round out the recommendations a little bit. So the one in bold here is the recommendation that I just made. The rest of this presentation deals with some fine-tuning, if you will, that Congress did not ask about. I'm just throwing that out there, and I hope nobody gets mad that I'm taking this initiative. But I think since Congress mentioned the thrift savings plan, it should be the standard. And I'm going to say this, there is a de facto standard I'm going to talk about, but it's not the right standard. The thrift savings plan, I think, is a much better standard that should be used for evaluating target date funds, for evaluating candidates and everything else. Something they didn't ask about, but I think is very much discussed in the industry, that it would make sense to have a lifetime annuity option associated for all retiring beneficiaries. And annuities they're a good idea, but right now the interest rates are so low that they're not selling. By the way, one of the episodes we did, you remember, Kath, on annuities?
Yeah.
Insurance companies aren't making money on them anymore, even though
Right.
people
Yeah.
say they're making too much money. They're not because interest rates are so low. But they're still a good idea, and they should be in there. And then this is a nuance, but if you will go along with my recommendation that safety at the target date is paramount, most beneficiaries, by the way, take their money out when they retire. So that they're done, and whatever they do after that is certainly, hopefully, a good thing. But for those people who stay in the plan, being very, very safe for the next 30 years is not going to get them through because interest rates are almost zero. So I'm going to talk about something that is innovative, new, only being done in a couple cases. But it makes a lot of sense that be very, very safe in the risk zone, avoid seekers return risk. But then as people move more and more into retirement, to actually increase the risk. So you have a rising equity glide path. So I'm going to talk about those additional recommendations, but just for a summary, where we are on the next slide, Kath. What I don't want to see happen, and really strongly recommend that the GAO say this when they issue their report, that there's a lesson that we learned in the 2009 hearings. So the recommendation was to put equity allocation in the fund name. So it'd be like the 2050 fund ending 60% in equities. There was a lot of pushback, and it was justified because equity allocation is just too simple of a measure. There's more to risk than that. So by contrast, I suggest appointing a committee, and they be charged with defining the risk of loss at the target date. And again, I have some ideas I'd be happy to share, but I don't want to contaminate the committee with those right now. But if they want to talk, I'm happy to talk to them. And then the disclosure would be, the fund name would have the level of risk of loss, and the disposition should be that there's an independent committee who decides on these. So it's not, I guess what I envision is if somebody wants to fight this, they're going to have to challenge the credentials of the committee or somehow challenge the recommendation, which I hope will be solid and make a lot of sense. So now we've done everything we set out to do, and I'm glad I did it fast because if we don't get through the rest of the show, we're good.
Ron, you got a statement here from Jack. Okay, so he says issues far beyond investment risk at target date meaning varies, mixed use, lack of transparency, diversity of financial literacy, status objectives of participants at every age. And then he put need GAO to go beyond the request from Congress and take the initiative to answer other issues.
I agree. No, that would be wonderful. So I'm going to do that here to some extent, but it's certainly not what GAO has been charged to do. But I really agree with Jack when they do answer. By the way, I'm told that it's not an option when the GAO gets these kind of requests from Congress. It's a mandate. They can't just fluff it off and do nothing. So there will be a response. It may take a while, but there will be. So I want to cover some of those issues, Jack. Thanks for suggesting it. Let's start with why glide paths differ. And next slide, Kath. This is really revealing. The typical target date fund is on the bottom there, and the bottom line of glide path as it is now, if you consider that bonds are risky now, it's not even a glide path. It's 90% in risky assets for all ages. No, they might be somewhat less risky because bonds are presumably less risky than equities, but it's pretty much constant risk through time. The TSP glide path, on the other hand, is on the top, and you can see it's pretty high risk, just like the other cohort for younger people, 40 years to retirement. But at the target date, it's 70% in very low risk assets, and they basically have They buy special government bonds where the U.S. government guarantees principal protection. So those are very safe assets. So 5% risky bonds, 25% in equities, and 70% is very safe. So really, really different. Really different because of the belief that the protection is paramount. Then the other thing that people who don't know about target date funds, that is on the next slide. This is the idea between two and through. So in the hearings in 2009, some of the fund companies said they took a lot of risk at the target date because they intend to serve the beneficiary for life. And those are called through funds. And the idea there is that the target date is just a speed bump in the highway of life. On the other hand, some of the target date fund people said they really do have a two fund. They expect people to take their money out. So their glide path ends at the target date. And that has created this Department of Labor made this recommendation to, when you consider a target date fund, to decide which you like better, a two or a through. And people have come to believe that the two funds are safer because they're trying to get people to the target date safely. Bottom line, that's not always true. There are some two funds that have more risk at the target date than some through funds. So this is a distinction without a difference. The next slide, I want to show people my patented glide path. And I'm not going to drag people through all the mechanics here, but let me say the emphasis for younger participants is very broad diversification. The efficient frontier moves up and to the left. Then as people get close to retirement, that line there won a Nobel Prize. It's called the capital market line. And it basically blends a world portfolio with the very safe assets. Basically, in my case, it's intermediate TIPS, Treasury Inflation Protection Securities, and Treasury bills. And the mathematics would have me be entirely in very safe assets when you're 65 years old. But I have to hold back some. So I'm basically about 70%, like the TSP at the target date. So the next thing is on the next slide, Kath. And this is showing you what is a new innovation that basically says you want to be very, very safe near the retirement date to avoid the sequence return risk and the risk zone, but recognize that you can't live on those assets for the next 20, 30 years. So there's some very thoughtful research that was done by Professor Wade Pfau and Michael Kitces, where they basically recommend re-risking. Now, you don't get crazy. When you're 90 years old, you can see you're nowhere near as much risk as you were when you were 40. But the idea here essentially is you need to try to get a little bit more from the capital markets. So you sort of need to re-risk. And this, by the way, this is both a to fund and a through fund. It's to because it has lowest equity allocation at the target date, and it's through because it's serving through the end of life. So the next things I want to cover here, sort of in line with Jack Tarochione's recommendation, is why multiple glide paths. So many of the Congress's questions deal with this, but there can only be one default glide path. And in my opinion, that really should be as safe as it can be. It should be very defensive. But for non-defaulted beneficiaries who like the idea of having something sort of on cruise control that's going to automatically rebalance and move towards more defensiveness through time, it can't hurt to have options for them. And I really think they should. And then on the next slide, I show you what those options look like in my world. So I would advocate this V-shaped glide path, but the very conservative one would be the one on the bottom. And again, the format here is the one we've been using all along. The equity allocation is on the vertical scale, and then the time of retirement is on the horizontal. And then you would have a somewhat more risky one, call it moderate, and then you had an even more risky one called growth. And non-defaulter participants could move between those, from time to time, hopefully with some sort of help and guidance. And then finally, we're in the home stretch here, Kath. We're going to go through probably the most critical question. Congress has very much implied in its letter that it would like to see target date funds be safe. But the world doesn't really agree in that safety principle. So we've been talking about this, but let me list 6 reasons why the qualified default investment alternatives. I'm not going to not just the target date fund. There are other qualified default investment alternatives that could be used. It's called a balanced account or a managed account. But let's start with the next one, Kath. So most participants will take their money out at the target date, and they're going to pass the baton to either an annuity or an IRA rollover, and recognize that that new entity is basically replacing what was wonderful in the old days. It would be a defined benefit plan that would basically give you an annuity. If you're unlucky enough to drop the baton, the rest of your life is going to be much less pretty. And it's just the luck of the draw in many ways. An analogy that's used is if you buy a house and you've got the down payment, would you be silly enough to put that down payment at risk and maybe give up the fact that you're not going to be able to own that house? Probably not. Now, the other thing on the next slide is just to reinforce that we're not talking about taking just a little bit of your money out and moving it to the new regime, to your retirement assets. It's almost always all of your assets. So it's all or nothing. The second reason is on the next slide. Reason number 2. And that we talked about, the sequence of return risk and the risk zone are real. And so far, people who were there in 2008 were not the baby boomers. The baby boomers now are in the risk zone. They weren't then. And back in 2008, there was $200 billion in target date funds. Now there's $2.5 trillion. So if this bad thing happens to people in the risk zone during this decade, it's going to be catastrophic. Reason number 3 is on the next slide. And I'm just reinforcing what we said before, but the Department of Labor said to consider demographics. This financial lack of sophistication is a demographic. Then the 4th one is on the next slide. There is a retirement crisis, and it is a justification for taking more risk. In one of our shows, we had this fact: 70% of baby boomers, 55 million people, have saved less than $300,000. And that, on its surface, would say, these people, they're going to have a terrible time in retirement. And we show in that show is that life is not miserable. You can certainly live on that and Social Security reasonably well. This is not fancy living. But most importantly, there's this SEC report, the last bullet on the right-hand side here. And by the way, if you get this show, the links will all open up for you. But it's a great report. I think it's about 10 pages, but it's very clear that the answer is not to expose the assets to more risk. In fact, exposing the assets to more risk is probably the worst thing you can do. What you really need to do is to change investor behavior and educate people. And one of the things that is supposed to be done soon, I don't know when the date is, but there's going to be routine reporting of retirement adequacy in your 401k statements. So you're going to see that if you keep saving the way you are, you're going to live on $100 a month or $100,000 a month, whatever it is. And that really should spur people into waking up, and if they're not saving enough, to start to save more. So that's the 5th reason, the 4th reason. The 5th reason is on the next slide, Kath. And I sort of mentioned this, but we have a minimum that we've never seen before. We've never had so many people in the risk zone at the same time. And they're going to be in the risk zone for most of this decade. And that's why I wrote the book, the Baby Boomer Investing book in the perilous decade of the 2020s. So our responsibility to baby boomers is a critical reason. And if you want to look at it from a selfish point of view, if those people lose a lot of their savings, they're going to become more and more dependent on society. And thankfully, our society wants to take care of them, but it's will we be able to? And the sixth and last reason, like you really need another reason, is my concerns about this decade aren't without precedent. So there have been decades here where all the assets, stocks, bonds, cash, lost money. They lost money in the 1910s, decade of the 1910s. They all lost money in the decade of the 1970s. So don't shrug this off as some think that you can't get through 10 years and lose money. Well, you can. And in fact, the Great Depression lasted 10 years. So the next thing I want to talk about briefly is benchmarks. And this, Jack, is something GAO should deal with as well. I'm going to make a suggestion. So next slide, Kath. I've written a couple articles. One is in the Journal of Performance Measurement, and it reviews all the candidates for being a benchmark and makes a recommendation. And then an article that just came out last month. This just won't surprise you, but the best performing target date funds over the last 12 years have by far been the riskiest. And that's clear why, because the stock markets have gone up like crazy. So they've been rewarded with really good performance and a lot of assets, and it's the message in the article is basically those really good performers are really risky. Do you really want to stay with them? So if you will go along with what I believe the objective is to protect the assets, the thrift savings plan really should be the benchmark, and that's the punchline of that one. Then on the next slide, Kath, this a review of our show. So our fourth show ever of the Baby Boomer Investing Show was about the scandal in target date funds. And what we basically say there is attorneys are always looking for some reason to sue. And most people don't like attorneys, but they've done a service to the industry in the area of excessive fees. So attorneys have gotten rich doing it, but they've actually corrected a real injustice with fiduciaries not being careful in getting the best fee deal that they can. It wouldn't surprise me at all if when the next market crash happens and we got $2.5 trillion involved, if all of a sudden the world wakes up and says, why were you taking all that risk to begin with? And that could lead to some litigation, some lawsuits. The last thing I want to remind people of, Kath, is we have a library. It's on the Target Date Solutions website. It's called the Fiduciary Corner. And then the rest of this is an appendix for people who download the presentation. And I won't go through that, but if you download it, all the links are there. And you find on SlideShare, I think in a lot of cases, when I posted on LinkedIn, I gave people a link to some of the stuff in SlideShare doesn't open up the links. I don't know why. So if you see it on LinkedIn, that the PDF should actually open up. So that should be good. So Kath, I think I actually did this in our normal time.
Yeah.
I apologize for maybe going too fast.
We got a couple more.
Yeah. Well, this is I'll just tell you what the appendix is, the up close look at the TSP through savings plan and all the funds that are in there. Then a couple of articles that I've written.
Okay.
And this one's sort of clever. It says, who should design a target date fund? And if you're an investment manager and the purpose for your company is to make money, and that is the purpose, you would design a fund to give you the most profit. Whereas if you hired an independent financial engineer to conform the glide path to what retirement researchers say you should do, basically protecting the risk zone, you would have the TSP kind of glide path. That's the nature of that article. And then the next one is about conflicts of interest. And there are three interested groups in target date funds: beneficiaries, consultants, and investment managers. and they all have different interests. And ideally, what you'd like to do is have all the interests align with the beneficiary's interest. And that's what that is about. And then we'll cover the last slide is just reminding people I have a book. Please buy it. It's really good.
Yes, it is. Yes, it is.
And then you can help us by clicking on the follow button or whatever you're doing here. Join, whatever. Please click on that button and join us, like us, do all that stuff. And then we have some websites for those who want to do it yourself. You can do it at H-Stage Robo. If you want to consult, you can go to Glide Path Wealth Management. If you're fiduciary and doing target date funds, you can look at the smart funds. So this we can help each other, and that's what this is all about. So, we have any questions, Kath?
No, I have none.
Okay, nobody said anything?
No. Actually, we forgot to mention that Dale was here.
Okay, great. Hi, Dale.
And he said "and family," so that was way at the beginning. So I'm not really sure. I think we were talking about the target date. So
great.
Okay, so what's our next show, Ron?
The next one, we're going to have a guest, and I think the guest is going to be a lady who specializes in working with old people who want to get out of this country. And
really?
And it's about places you can live a really nice lifestyle on not too much money.
Really?
And it just sounds so intriguing. And I mean, just between you and me, I'm concerned about all this money printing that's going on and what's going to happen here.
Yeah.
So I thought I'm going to be more. I'm not interested in moving. I love this country. I thought it might be fun to hear what she's been doing. She advises people, and the things like what do you give up your citizenship? What do you do? Anyway, I thought it'd be fun. So this was a serious one. We're going to follow up with something more fun.
Okay. All right, everyone. We'll see you in a couple of weeks.
Great.
Thanks for watching. Thanks for watching.
Thank you.